And we start off with the markets putting on its own fireworks show on this 5th of July and staging a reversal. The Dow dropping more than 200 points at the lows of the session after a strong jobs report tempered hopes of a rate cut, but ended the day down just 40 points. Meantime, the yield on the 10-year yield jumping back above 2%. President Trump blasting the Fed when speaking to reporters earlier today.
We're paying a lot of interest and it's unnecessary, but we don't have a Fed that knows what they're doing, so it's one of those little things. But if we had a Fed that would lower rates, you would have a rocket ship.
So what is the market saying now about what it expects for a potential rate cut this month?
Didn't Bullard and Powell dress down the window for a rate cut last week, or at least going from 50 to 25 basis points? I think Powell should dress down the window. I don't think he should cut.
At all.
The market thinks that he should cut, but you have limited amount of ammo, so why not string it out a little bit longer? The market's at all-time highs.
But wasn't the argument that the Fed had moved too far, and that this was really and that this was really more of an equilibrium cut, and that this was a proactive cut, which, by the way, markets like. If you look at the stock market, when the Fed is actually proactive as opposed to reactive in terms of cutting, it's a market positive event. The question is, was good news today bad news for that? And if you look at Fed funds futures in terms of what we should expect for July, look, 100% in my view, we go 25 basis points in July. There's no way to avoid it.
And the market's finished. Right around
the thing is, how could the market really care? I mean, here we are with 10-year money basically as cheap as it is. Is there really a difference between 215, 225, 195, and the market's getting so excited, disappointed? The payrolls were good, they weren't good. It's absurd.
Isn't there a difference, though, if it does bring the 2-year down, the yield on the 2-year, and so it prevents
maybe at some point you kick in the refis and all that, but at the end of the day, this is not what should be driving the market, right?
Right.
It's about the fact that earnings revisions are the worst in almost 13 years for Q2 going into the quarter, and that we're slowing.
But to Melissa's point, the reason why you saw financials lead was that if there's some type of action and you don't get that inversion.
Remember, these are stocks that are down still 30 and 40% from their highs.
I think the big takeaway for me was that the market closed right around all-time highs. We shook it off. You had retail space. A lot of these department stores that couldn't see a bid, getting a bid back because maybe the economy isn't terrible.
Well, I think that if you looked at the 15 best performing stocks in the S&P today, they have one common characteristic. They're all still about 40% below their 52-week high, meaning it's catch-up trade. If you want to do something, it's that kind of thing, rather than the Microsofts, which are a little stretched.
Is that a wise strategy, though? A catch-up trade?
No, I think right now, it still makes sense to be defensive. I mean, that defensive safety trade has worked very well since September 30th. I think it continues to work unless and until we hear a significant positive tone shift from CEOs on this next round of earnings calls.
So in your view, what is defensive, just to be clear? Because some people will say defensive is healthcare, utilities, REITs. Others will say it's technology.
So I think on a more immediate basis, I would say defensive would be consumer staples, utilities, REITs. I love the healthcare sector. I just think there's too many political headwinds right now. It's going to take a little longer for a lot of those stocks to really pan out.
So defensive in the form of something like Google, where I look at the valuation, I look at the PEG ratio, and I say I can feel very comfortable here, even independent of the headlines. I do think that consumer discretionary, we spent a lot of time talking about fast food. We've spent a lot of talking about consumer staples. We've talked even a little bit about some of the discretionary purchases, and even a Nike, despite some of the news in the last week. I think what Mark is saying is that during these times, these have been the names that have continued to outperform. This is one of those times, and I agree, Carter, with what you're saying in terms of who cares what's 10 or 15 basis points on the margin, but this has been all about the Fed. This has been all about easing. This is why stocks are going higher, and therefore it doesn't surprise me that the market is oscillating here a little bit on a day when, frankly, there weren't a lot of people at their desks.
But if you think about it, right, if you believe in the Fed model, you believe in a dividend discount model, if you believe in the inverse of the PE, the earnings yield, the market should be much higher. Why isn't it surging? Why are we only basically unch for 18 months?
Because there's so much unknown in the marketplace right now.
All of which could break the wrong way.
Of course, that's the way markets are constantly. But I think it's kept the bears sort of on their heels, because why would you want to lean in and go short the market or really go? I think positioning is the reason why the market's acting the way it's acting. The reason why it keeps rallying after every type of sell-off where people aren't long enough. They got caught short on the lows, and now they're trying to catch up. And a lot of those names are the retail space that's been performing terrible. People just want to cover now.
I'm not sure I'm following, because you said if you're a bear, why would you want to lean in? But then you're saying
they got short at 27.22 in the S&P. They went all in. And then all of a sudden you had this rally where Powell did his pivot, which we haven't seen in quite some time.
At the end of the
and
day,
then that's where they had to
even holding
catch up and
aside
cover.
trades, you can look at all of the work that's done out there. What are the expected returns for equities? Forget about a sort of a trading show like this, but looking out maybe 2 and 3 years from here, is this a risk-reward opportunity that's good to be in equities or otherwise? I mean, really,
well, I can't put on that. That's
Well,
not.
what'd you
I don't
say?
look out.
I would
What
say
would
it's
you say?
it's not a favorable trajectory.
But if you would have said that, how long ago could you have said that? It wasn't favorable.
Well, that's
How
the
long-
whole point.
Right, but
we're already
you would have been
18 months
sitting
and
on
people have been bullish all the way, and we haven't done anything in a year and a half.
But were you bullish?
And
That's
the
my point.
kids,
I'm not talking about Carter.
The children, so to speak, the child still needs extra help. It's like, no, he's okay, but
I
he's
got
gotta
it, but
keep
look at
going
the
into
rally
teacher,
that you would have
and
missed.
The Fed will help you. The Fed
But
will
look
help
at the
you.
rally you would have missed if you would have said, because I could have made the case that it wasn't,
You're not
it
missing
wasn't the right
anything.
time to be in
It's 18
equity.
months with no pay
Okay,
and
so
adjusted for risk.
Given
You're being
your
murdered.
outlook, Carter, because I'm sure there are people out there who are in your boat, what would you invest in?
I mean, basically, you have to either be, if you have to be in equities, you have to be in the safety trade, which is, and yet everyone knows how expensive utilities are, and they know how expensive reasons. So it's again musical chairs, and people say it's like almost like that. I have to keep dancing, but you don't. You can be in cash, or you can find a name here and a name there. But the notion that you have to be in equities and you have to embrace this theme or that theme, growth versus value, it's all just not true.
Well, yeah, and look, I agree on a risk-adjusted basis. Carter's telling you that if you for the last 18 months dealt with the volatility we've had, which has been historic, not a great trade, but there have been plenty of opportunities to rotate in stocks, and we've seen a pretty safe rotation period over the last couple months. So the question back to you, I would say, Carter, retail has underperformed the S&P by 20% in the last year. From a charts perspective,
like
from
an equal weight thing like the XRT.
Well, I mean, now that we've gotten some affirmation that look, the 6-month payrolls are at 165 to 170 on average, and in the 1 year, I bring those numbers up, is the consumers probably about the same place they were on a payroll number from where they were a year ago, and yet retail stocks are down 20%. So does today's number give you a reason to get more comfortable on oversold retail?
Well, we're maybe going to talk about one of those later, but conceptually, that's a trading thing. And more importantly, there's a structural problem in retail. I mean, that's the point of the XRT making 10-year relative lows.
So before we move on, let me ask this question. If the Fed does not cut rates, which is what you think the Fed should do, not cut rates.
Yeah, knee-jerk is going to be what you saw today.
What would you, if you had a crystal ball, it's telling you the Fed's not going to cut rates, what do you do today to your portfolio?
Yeah, I mean, I think you probably want to risk adjust.
So you got to run for cover if the cost of 10-year money stays at 2%. So you need more extra help.
You sell now into that meeting, but I think that you would buy the marketplace. But if you were in cash, you missed the market.
But you're saying that if the market doesn't get more extra help from the teacher,
if
the market doesn't get more extra help from the teacher,
no, wait. Take a step back.
If the market doesn't get more extra help, you got to run. You said run.
How about you let me speak for what you're asking me? You're telling me what I would say. So I don't think that the Fed should be cutting. I think that the market is.
Go ahead.
I think that the market should deal with what the market has, but right now the market is addicted to it.
And so the addict needs more, and you're saying if the addict doesn't get more, you want to run.
Do you want me to? You should have been a psychologist or a psychiatrist.
That's terrifying.
You need to put on a different hat because the market right now needs the juice that it's getting from the Fed. It proves it constantly.
That's my point.
And if you sat on the sidelines and went to cash, you made nothing this year.
You're playing a game. You're using words like addiction,
I just want to make money.
musical chairs.
Right.
That's the point.
I just want to make money.
We got